Okay, estate planning. Making sure the assets end up with the right people at the right time. I cannot overstress how important this session of planning will be. And clearly, if you are on our one-to-one program, we will be doing this with you and going through the various options. Likewise, if you're in our mastermind group, we'll have the opportunity to chat online in the group, and a lot will come from that session, I can assure you. If you're in our online program where you have the information, that in itself is a really, really good place for you to be. It's a fabulous start, and you'll have the PDF, our specific estate planning PDF document, which highlights the 10 key points or questions that you need to be mindful of. It is crucial, so important that we get this right. Here I have resketched a basic bucket within which we have cash, ready realisable assets, and we also have a property, we also have a pension, and we also have a business. There we go. Now what I'm going to do is I'm going to draw a further cap on that so we can see that we've got everything in this nice capsule. And at the top I'm going to draw a couple. I'm going to use a husband and a wife example. Down here we have, and I'm just going to stick with 3 children, okay, all of whom the intention is to pass an equal share of this estate. And this could be anyone's estate. This is a couple with 3 children. The idea and name of the game is to get through a fabulous retirement, enjoy a great life, having worked out the number, having worked out what we want to do with our time, so we get that great desired lifestyle. And the name of the game, the object of the game, is to get through 20 years, 30-year retirements, have a great life, and then ultimately be left with something to pass on to the children safely and tax efficiently. Now let's talk about tax efficiently to start with. Clearly everything above £650,000 at the moment is taxed at 40%. We all have a £325,000 nil rate band. That's how it is. We are allowed to pass £325,000 each onto our beneficiaries minus any tax. There is a potential uplift of another £175,000 per person in a residential nil rate band, so we can possibly in some situations pass up to £500,000 each. But that is a tapered down bonus relief, and I'm not too sure how long it will be around for. We will have to see, but let's safely say that you have at least £325,000 each that can be passed tax free. So that deals with the tax efficiently side of it. To make it tax efficient, we would then need to look at what was sat above £650,000, to use this married couple's example, and come up with a strategy to pass the rest of the money tax efficiently, if indeed we can. And clearly that would need to be worked through in your course workbook, or through our mastermind sessions, or indeed on our one-to-one core program. When we talk about safely, there are so many dangers and pitfalls and hurdles to look out for. Let's sketch one out as an example. If this partner was to pass away, the will might pass 100% of everything to his spouse. So this husband passes everything to his wife. Now there's no tax at that point, because there's no tax between a husband and a wife. £325,000 nil rate bands aside, the estate has all passed to the spouse. Now, if the spouse doesn't do anything for the rest of her life in this case, and ultimately passes away, the estate will pass to these 3 children in equal portions. But that might not be too bad if the estate is modest. Let's say that the readily realisable assets, the cash, all of the investments in personal chattels, let's say they were worth £1 million, which isn't uncommon nowadays. And let's say that there was also business value and property value and other things as well over on this side of the bucket at another £1 million. Well, that would be passing £2 million to these children, which is, not an insignificant amount of money. Now, if these children themselves receive that money, you have to ask yourself the question, if they just get it directly, what will they do with it? It might be the case, particularly if they're young, that it would be unwise to let them inherit that much money directly. They could get into a heap of trouble with it. Even if your children are very well behaved and aren't, looking for trouble, so to speak, in certain cases, and it happens a lot, it can give rise to problems, in so much as if other people find out that they've inherited, a couple of £1 million between them, all of a sudden they can start to attract the wrong kind of friends. Does that make sense? The wrong type of people can all of a sudden become more interested in your children than perhaps what they may have once been. So there are potential risks for the children when inheriting any amount of money, let alone a couple of £1 million. So we need to be really clear and careful about that and put plans in place to make sure that that situation doesn't become a problem for your family. Sideways disinheritances can happen through vulnerability. Sideways disinheritances can also come about if the money passes to your children, a couple of £1 million in this example, but let's say that the partners, wives, husbands, significant others attached to your children, if these relationships break down, if one or more of the relationships break down, it could see a large part of that couple of £1 million pass to those ex-wives, ex-husbands. They could effectively run off with a large chunk of the money. Quite often, more often than not, that can be done on a 50-50 basis nowadays. But there's something else too. What if, in this example again, the wife remarries? And this could possibly be 5 years, 10 years, 15 years down the line. Well, in this situation here, if this spouse remarried and didn't do any new will planning at all, and then passed away also, that would effectively bypass the children down here and send 100% of what had been inherited onto this new partner, this new wife, this new husband over here, completely bypassing the 3 children who it was intended would inherit the estate. And, it might sound extreme, but it's not, and it's fairly common. These things are happening all the time. So there is a significant risk of sideways disinheritance on second marriage, but also through no additional marriages, just through the children inheriting their estate directly. So what can we do to solve these problems of sideways disinheritances, both on second marriage or indeed just on a direct inheritance basis? What we would typically do is create a family trust which sits around the whole of the family unit, and let's just bypass this this new partner at this point. If we were to create a family trust around this whole estate, what it would mean is the assets and capital within it could ultimately pass to these 3 beneficiaries here. But the way in which they receive the capital and assets and the income from them can be controlled. So we can have external trustees over here who can control what's going on, and they would be in addition to your executors, and quite often they are the same as the executors in the will. But by creating a trust around the estate, we can mitigate lots of these problems. The other thing to say is, if there is going to be a marriage again later on down the line, we would also split the estate in half. So rather than just creating a big master trust, so to speak, it might be that we arrange the estate into what we call tenants in common, as opposed to joint tenants, which is what it all is as standard. So by doing that, what we can do is, on first death, we can pass 50% to the surviving spouse, and we can earmark the other 50% in a discretionary trust for the children, for the beneficiaries, for the next of kin, whoever they may be. And the added benefit of doing that is, if there is a second marriage that takes place at some point down in the future. 50% can pass to the new wife or husband or new partner, and that's fine because it's probably fair. This relationship crystallises and starts a new life of its own, and when that partner passes eventually, if they go first and vice versa, 50% of their estates can obviously pass to their, second wife or second husband or second partner, with the balance paid to their own existing first marital estate, for example, bearing in mind that this individual here might also have children from a previous relationship. So making this whole estate plan work is super important. Typically, we find that most of the wills we come across don't create this type of structure that I'm talking about now. They tend to just pass 100% spouse to spouse. That is a really kind of dangerous setup, and it's incredible. It just never ceases to amaze me, how many estates I come across where just 100% goes spouse to spouse. It's just like really not sensible at all. And it doesn't have to be, a £2 million estate. I mean, anything over a few £100,000 can still cause trouble. And what I would say is, if you want any evidence of these, problems being real life everyday problems, just take a trip down to the family courts and you'll see contested probate cases all over. Because what can also happen, if it's not done properly and set up right, the children can become involved in legal battles with partners who came into the relationship late in the day. It can just go very wrong very quickly. So it's far better to just work it all out at the start and come up with a proper plan and a structure. And more often than not, that's going to involve making wills which are 50-50, tenants in common. It's going to involve splitting main residence property in half so that both parties own half the house each as opposed to owning 100% jointly. And it's about making sure that any business assets can pass into a business assets trust, because that can make them super tax efficient as well. Whilst there's no tax on most business assets now, if they just drop into the estate and crystallise as cash, ultimately when that cash passes down the bloodline, at some point it would be taxed, more often not at 40%. Well, if the business value sits in a discretionary trust, it can pass to beneficiaries and it can filter down the bloodline for 125 years. So it's about being clever with the structures we use. Now, you've got a number of options now in terms of how we would move this forward. You can complete your PDF and email it over to the team. We will give you your free estate planning report to tell you exactly what we would do with your estate. That's if you're on our online program. You can still do that if you're in our mastermind program. Not only that, you get access to the other 50 or other 49 group members, I should say. There can be a big conversation on there where people are comparing notes and talking about their own situations, both generically and specifically. There's no bars on that. And clearly, if you are a one-to-one client, the chances are that we're probably already talking to you about this exact dynamic right now. And it might also be the case that we've already protected you and you have the right structures in place, and they normally consist of non-standard wills. They normally consist of nil rate band planning, so those 325,000 can be catered for on first and second death. They always typically include the residential nil rate band element too, which gives another 175,000 on either side, so we can effectively move £1 million into discretionary trust on first and then into second death. And then we will always typically end up with a life interest settlement, which is the master family trust, which we, depending upon the situation, might call a beneficiary protection plan. And then we would also complement that with a protective gifting trust structure too. And that's so you can make gifts out of your bucket, out of your estate during your lifetime, such that we can start to use the nil rate band. And we would do that typically every 7 years, because every 7 years, forgetting everything else we've just talked about, you can effectively create your nil rate bands and move 325,000 into trust. And after 7 years, it falls outside of your estate and you can do the same again. So we can use the protective gift structure all the way through as a lifetime piece of planning, whereas the nil rate band and residential nil rate band and beneficiary protection plan or life interest settlement structures are essentially the post-death elements of the planning, post-passing elements of the planning. So it's about creating that lifetime planning and the post-death planning and blending them together. That's what we'll be doing for you on a one-to-one basis if you're a core client. That's what we'll be talking about in our mastermind group if you're one of the lucky 50 who have opted for that option. And it's certainly what we will be helping you plan with when we produce your report if you are on our online program. So look at the PDF, look at the supporting literature and documents that are in your course portal. Everybody has access to those. Remember this short video presentation which I've tried to conceptualize the problems, the potential solutions and the things to watch out for. So look at all that. Let's talk on it shortly, and one way or another we will make sure your estate and your retirement incorporates the bulletproof plan, which is the very essence of everything I've just spoken of.